Now that you've maximized your cash flow, it's time to move to the next step, growing your net worth. As we said a bit ago, all your positive cash flow is fuel for your wealth. And like a rocket, the more fuel you have, the faster and higher your wealth will go when you use it to buy income-producing assets and pay off your debt. When you look at this balance sheet, or when you look at your own, what kinds of things could this person do to grow their net worth? Let's go to the asset side of the balance sheet first. As you know, there are a few common types of appreciating assets. There's investment real estate, that rental property you buy to rent out to tenants. There are businesses that you can start or invest in. And there are the assets available from the investment marketplaces, such as stocks, bonds, mutual funds, and so forth. They each have their own strengths and weaknesses, their own cycles and risks. So you might want to think about what area interests you most or makes the most sense for your financial situation and start there. If real estate is your thing, you can start small with a local condo or a small house and grow from there. If you love business and have a knack for that, you may want to find the right business to start or invest in, perhaps something local. Or if you just want to invest from the comfort of home and not deal with the hassles of tenants or employees, you can buy investment paper like stocks and bonds. A couple of tips. The most powerful investment vehicle is your own company's 401k or retirement plan, if you have one, because the money you save there is protected from taxes until withdrawal years later. And it lowers your tax bill by reducing your taxable income while giving you years of compounding growth. And if your employer matches the first 2, 3, or 5% of your retirement contributions, that is free money, and you would be foolish not to take it. If you don't have an employer offering a retirement plan, look into your own retirement plan with a Roth IRA or a similar investment. Second tip, don't try to time the market. Studies show that the best money managers in the world don't do as well over time as the market indexes themselves. And the managers cost a lot more. If you try to do what even the professionals can't do, it's just going to be very expensive for you in losses and trading fees, and it will slow down your wealth rocket. Invest in low-cost funds that give your portfolio diversity and that simply track the market index. Keep contributing to it consistently, no matter whether the market is up or down, and over time, you will come out ahead. Ramit Sethi, the New York Times best-selling author of the book I Will Teach You to Be Rich, recommends the following 5-layer investment strategy. First, put in as much to your company's 401k as it takes to get all the matching funds from your employer. Then, pay off any outstanding debt you have, except for your house or car. Pay off the credit cards, the retail accounts, and any personal loans. After you've done that, move to step 3, which is to open a Roth IRA and contribute as much money as possible to it. If you have money left over, then go back to your 401k and contribute as much as you can to that, beyond the employer matching. And finally, when you still have money left over, open a regular, non-retirement investment account and put as much as possible there. Now let's go look at the liabilities. You have different kinds of loans on your balance sheet, but the common ones are credit card debt, personal loans, student loans, a mortgage, and car loans. Let me teach you the fastest way to pay off your debt. It's very simple. Pay as much as you can every month to the highest interest loan, and just pay the minimum payment on the rest until that first one is paid off. So let's say you have 3 loans at different interest rates, one at 5%, one at 10%, and one at 15%. You want to pay as much as you can on the most expensive loan first, that loan at 15%, and just pay the minimums on the others. So for example, you pay $100 a month on that high interest loan. and you just pay $30 on the other two. And you do that every month until that first loan is paid off. When you pay off that first loan, then you target the next highest loan, the 10% loan. You take the $100 you were paying on the first loan plus the $30 you've already been paying on the second one, and you combine them to pay off the second loan. So now you're paying off the second loan with $130 every month. And when you pay off that second loan, you go to the third. You take the $130 you were paying before, you add it to the $30 on the third loan, so now you're paying $160 a month on that last loan until it's paid off and your debt is gone. This is called the snowball method because your snowball is growing as you roll down the hill through each debt. This enables you to pay off debt quickly because you're combining the power of your money over time, and you're knocking out the interest you pay as quickly as possible by paying off the most expensive ones first. Credit cards and consumer debt often have the highest interest rate, so that's the most common place to start paying off your debt. Take some time now and look at your balance sheet. Think about what appreciating assets you want to buy and come up with a strategy for paying off your liabilities. The financial expert Dave Ramsey, author of numerous best-selling books on personal finance, recommends this strategy. First, establish a $1,000 emergency fund. This creates a basic system to protect your finances from any unexpected shocks and prevents you from any more borrowing. Second, pay off all your debt except the house. Third, build up 3 to 6 months worth of expenses for bigger emergencies, such as a job loss. Fourth, fully fund 15% of your income into pre-tax retirement plans and Roth IRAs. Fifth, put away money for your kids' college education. Sixth, pay off your home mortgage early. And finally, build your wealth by investing in mutual funds and real estate. Now, this strategy may or may not be the one you want to follow. Whatever strategy you adopt will depend on your particular situation, financial goals, and temperament. And I recommend you consult with a professional financial advisor to help you lay out your own personal strategy. Remember that you can work either side of the balance sheet to grow your wealth. But take action. Do whatever you can do today, even if it's not perfect, and you can grow and refine your strategy from there. The most important thing is to get started and build some momentum.